You might be thinking you need a professional or an expert to find great quality companies to trade. You might be looking for newsletters, Facebook groups, Discord groups, or channels, and trying to figure out, hey, how do I find these hot stocks? How do I find the vehicles to trade? And what should I be trading? Well, the answer is actually quite simple. You don't have to chase hot stocks. And I'm going to share with you some insight here as we dig deeper into this video. Now, if you're brand new here, I'm Sasha, the options coach. Been trading options for many years now and do a lot of coaching sessions. We do a lot of classes as well when it comes to options trading. And if you're interested in those, check out our website at optionsblackbelt.com. In either case, a lot of people, what they do is they look for hot stocks. They're always constantly chasing. They're thinking about, well, what are the cool stocks, this year? So for 2025 or 2026, and the list keeps going on. What is Warren Buffett doing? What kind of stocks and vehicles are in those portfolios? Hey, what do you have? What does the newsletter say? What does the Discord or Facebook groups say? What stock should I be trading now? Can you give me some trade alerts? This happens nonstop all the time. And it does not work very well for other people, because what happens is that your risk tolerance is going to be different than somebody else's. So everybody's risk tolerance is a little different. And what happens is that you're looking down at this risk level that somebody has, and you're trying to mimic and copy this. But the problem is the timing behind it is not always going to be the same. Your timing might be off. Okay, meaning that even if they have a trade alert, you're going to be in a few seconds later. You might be in a few days later. Okay, your hold time also, okay, not just the entry time, your hold time is going to be different. And exit. Okay, the way that you exit, when you exit, how you exit. Maybe, let's say we're just talking about shares. Maybe they buy 100 shares and then they peel off 10 at a time. So all of a sudden, their management is also different. So you have to be very careful when you start to follow and copy trades and these kinds of things. They don't usually pan out very well. And that's just because the risk tolerances don't match up. The management style doesn't match up. Your experience doesn't match up, and that's okay. It doesn't have to for you to be profitable, for you to be successful or be consistent. What you need to do is have your own consistency. Okay. So if you're trying to run and have, let's say, cross-country running or track and field running. If you're trying to do that, you have to find your pace. Now, yes, you might push yourself a little bit, but your pace is the pace that you can follow and keep. And that's what most people don't do in trading. They're constantly looking for hot stocks, and there's no consistency behind it. Now, yes, there are certain criteria that you should have when it comes to finding some stocks. So normally I would say things that have, great volume, that also go in and have weekly traded options. So these things are kind of important. We also trade with options that with stock prices that are over, let's say $20 and more. That way, just the options value have a little bit more more value to them. So in either case, we need to have certain criteria in there. And of course, you could go in and say, well, I also want to trade dividend stocks in case I get assigned or something like that. And that's fine. But those are some basic criteria. Now, I have a whole long class on this. It's a whole hour long about some general criteria that you may want to watch. But the thing is that when we look at these criteria, that now eliminates some things. But what's more important is actually the consistency behind it. So rather than hopping from different vehicles and different things, you actually want to be more like the bricklayer. You want to become more on repetition and repeat the process, because what it does is it creates kind of consistency. So you're just repeating the same process. So let's say you're just selling a put on, it could be on SPY, it could be on SPX. You're selling puts day in and day out. It could be selling puts on Microsoft, looking to acquire the stock, or on Airbnb, different stocks and different vehicles. But the process and the procedure is the same, because how do you know that vehicle over time? Well, over time, after you get maybe a larger pullback, let's say in the position or in the vehicle, well, you might say, well, now I'll sell 2 puts, or I'll sell 3 puts, or maybe the delta of those positions might be a little stronger. So instead of doing a 10 delta on the put side, you might go into a 30 delta that you sell. So the point is that when you're in that vehicle and you start having consistency, you can repeat that process. And I'm not saying do it all in one stock or vehicle. It's nice to mix up and have multiple positions, maybe 5 to start out with would be nice. If you can do that, maybe 10 or 20 if you have a larger account, and that's fine too. But the point is that you're doing and repeating the same consistent process. Now, as your portfolio grows and as you have more money, let's just say a 6-figure account or larger, you might actually have multiple concepts of that bricklayer zones. So what you're doing is you're bringing in income from different areas. So even though you're stacking bricks in this one department or this one area, it's bringing you in a certain amount of capital. So let's say this is bringing you in $600 every week, and then you have another type of strategy and concept, but that process is also repeated time and time again. That could be, let's say, an iron condor, but again, the process, the procedure is repeated time and time again, over and over, just like a bricklayer. So you have different walls to that, to your whole portfolio. And then you might have another thing where you're doing some call it maybe fast or active trading. It could be day trading. It could be a different strategy like butterfly spreads or calendar spreads, but the principle is the same. Now you've got kind of three different strategies or concepts that are bringing you in money, but each one of them should be more like the bricklayer, where they're repeated time and time again and consistent, because this way you have consistency. You can see what you need for making some tweaks and changes and modifications if you need to do that, and adapt it to different market conditions that you may have. So anyways, that's how you want to think about when it comes to trading, rather than looking at hot stocks for 2026 or 2027 and beyond. You're actually looking for a stability in the vehicle. And as long as that vehicle is tradable, whether that's, with the volume, the weekly options, the bid-ask spread is tight, the volatility levels, maybe under 70s or 80s or so, looking at those kinds of things, and you're repeating the process time and time again, you'll be far more consistent than many other people who are looking for hot stocks and vehicles, because they are looking for appreciation, and that is the only way they are able to make money, because they have a limited knowledge base. However, with you, as you continue to expand and grow, you might be able to do things more with like iron condors, where you don't need the stock to move. You don't need movement in the progression of the stock to move higher. You're okay with sideways moves and actions, and that will be just fine. You'll still make the same amount of money whether the stock moves sideways or slightly up or slightly down. That's the beauty behind it, is that if you expand that knowledge base, you'll be way better off. Anyways, thank you so much for joining me. Truly appreciate it. And I hope you got a lot out of this video. Maybe I'll see you in one of my next future live classes. Take care.